Welcome to our weekly EUR/USD trading forecast and trading strategy, brought to you by X&Y Trading. Here at X&Y Trading, we specialize in technical and fundamental analysis, strategic trading plan development, and accurate price action forecasting. I am glad you have taken the time to join us for this all-important video about price action forecasting of the euro to US dollar, and we promise you some great strategies for trading the currency pair in the coming week. With 27 years of experience in the financial markets, I've been around long before Forex trading was a click away. Back then, trades were phoned in, and news traveled a lot slower. It was a whole different ballgame back then. Here at X&Y Trading, we provide you with solid, no-nonsense trading plans every week and every day to help both new traders and seasoned professionals build consistent, profitable trading accounts. And this is the best part to it all. We do this at absolutely no cost to you. It's just pure market analysis, built on hours of research, so you don't have to do the hard work yourself. You can join our WhatsApp group by clicking the link on the screen or in the video description. That way, you'll never miss out on key updates or daily forecasts we send out. Before we begin, please take a moment to read the disclaimer on screen and again at the end of the video. Trading Forex in the financial markets carries significant risk. You can lose more than you invest. Our analysis is for educational purposes only, so please trade responsibly. Let's dive into the forecast for EUR/USD for the week the 5th of May to the 9th of May 2025. We're entering the week with a neutral to slightly bearish bias on EUR/USD. Price is hovering just below key resistance and struggling to break higher, despite staying above the 200-day moving average, which still signals a longer-term bullish undertone. Let's look at price action and the technical overview of the EUR/USD. The EUR/USD is currently trading near 1.1298. Following a retracement from recent highs around 1.1500, this pullback suggests a temporary pause in bullish momentum. With price consolidating below a key resistance zone, let us have a look at the technical indicators. The RSI Relative Strength Index is holding at 57.5. reflecting neutral market momentum with no immediate overbought or oversold conditions. The MACD reveals a mild bullish crossover, though the associated momentum remains subdued, suggesting hesitation from buyers at current levels. The 200-day moving average sits at 1.0771, with price comfortably above it. This is certainly a signal that the longer-term bias remains bullish, despite the short-term correction. Volume flow has been declining on recent upward moves, signaling a reduction in buying pressure and possibly a fading appetite to push higher without a fresh catalyst. At X&Y Trading, we analyze the weekly, daily, and hourly volume and money flow combined with RSI, CMF, macroeconomic news, and central bank commentary. Based on this analysis, here are your key support and resistance zones. Mark these levels clearly on your chart so that you can refer to them at any time. Support zones. Support zone number 1 is between the 1.1250 and the 1.1270 level. Support zone number 2 is between the 1.1180 and the 1.1200 level. Support zone number 3 is between the 1.1100 and the 1.1120 level. Resistance zones. Now let's also mark out the resistance zones on the same chart. Resistance zone number 1 is between the 1.1360 and the 1.1380 level. Resistance zone number 2 is between the 1.1420 and the 1.1440 level. Resistance zone number 3 is between the 1.1500 and the 1.1520 level. It is also important to note that there's also a low volume area between 1.1300 and 1.1350, which may cause rapid price movement if broken. Volume spikes are especially visible at 1.1200. This level acts as support level for price dropping beneath. Volume spikes are also visible at the level of 1.1420 also. This level acts then as a resistance level for price going down below this level. One can expect some heavy reaction in price from the EUR/USD when price reaches levels near those support and resistance zones soon. Remember, you can join our WhatsApp group by clicking the link on the screen or in the video description. That way you'll never miss out on key updates or daily forecasts we send out. A very important aspect to this video is to supply our viewers and subscribers with some key technical levels on the EUR/USD currency pair. Let's first get some of the support zones and the price levels of the currency pair. Zone 1 is at the 1.12502 to 1.1270 level. It is important to know that this zone previously acted as resistance level in the past, and has now transitioned into support for future price action. The zone also aligns closely with the 20-day moving average, adding some technical confluence. Zone 2 is at the 1.11802 to 1.1200 level. This zone is a notable high-volume node, suggesting some strong historical participation in past price action that took place here. This area also represents a potential demand zone where buyers may re-enter the market. Zone 3 is at the 1.11002 to 1.1120 level. This zone is a key structural support level for the price action of the currency pair, and this zone or level was established by the March swing lows. A breakdown below this zone could indicate a shift in broader sentiment. Now let's look at some resistance zones. Resistance zone number 1 is at level of 1.1360 to 1.138. This range marks some recent swing highs and represents a potential supply zone where prior bullish momentum was exhausted. Resistance zone number 2 is at level of 1.14202 to 1.1440, also a critical confluence zone combining historical highs with Fibonacci retracement levels, making this zone technically significant for potential reversals or breakouts to the price of the EUR/USD. The ultimate resistance zone number 3 is at the 1.1500 to 1.1520 level. This level is a psychological barrier and the recent cycle peak. Price rocketed to this level on the back of some heavy momentum from buyers of the pair. A decisive break above this level could open the path to further bullish continuation. Let's look at volume and money flow insights. The Chaikin money flow, or CMF, remains in positive territory, but is trending downward and is signaling a gradual decline in buying pressure and potential loss of bullish momentum. The Money Flow Index, or MFI, is currently stabilizing near the 50 level, reflecting an equilibrium between buyers and sellers. This is a sign of market indecision or consolidation. Volume profile analysis reveals a prominent high-volume node around the 1.1200 level. This is suggesting some strong institutional interest and likely some support for price to hold in that region. In contrast, the 1.1300 to 1.1350 range shows a notable low-volume pocket. This may indicate a potential zone for sharp and accelerated price movement if price entered this zone. A fundamental overview of recent developments that affected the price of the EUR/USD. First was the ECB rate decision on April 17. The European Central Bank implemented a rate cut, lowering its key interest rate to 2.25%. This move was driven by ongoing economic headwinds and rising concerns over global trade instability. The market interpreted this as a dovish signal, contributing to a softer euro outlook. The heavy impact of heightened trade tensions between different countries on the globe, the escalating tariff measures imposed by the United States on European imports have introduced a layer of geopolitical uncertainty, which continues to weigh on euro sentiment. These developments have added pressure to the euro amid broader market risk aversion. Now let us look at some fundamental analysis on the EUR/USD that is coming up. Upcoming events to watch for this week, the 5th of May to the 9th of May, 2025. Let's start off on Wednesday, May 7th, 2025, with the Eurozone retail sales. Then on Thursday, May 8th, 2025, look at the ECB Economic Bulletin. And finally, the big one on Friday, May 9th, U.S. non-farm payrolls, the market mover. The ECB has recently signaled more dovish intentions, while the Fed remains cautious, widening the interest rate gap, which may limit euro strength short-term and do the opposite to the U.S. dollar. It's important to understand that increased demand for the U.S. dollar typically exerts downward pressure on the euro-USD pair, leading to a more bearish outlook for the euro relative to the dollar. Geopolitical and macroeconomic factors that may have an impact on the price action of the euro-USD is, let's start with interest rate differentials. The European Central Bank has adopted a more dovish monetary policy stance, particularly in comparison to the Federal Reserve's measured and data-driven approach. This divergence is contributing to a widening interest rate differential, which may place sustained downward pressure on the euro relative to the US dollar. Then let's look at the geopolitical risk landscape. Broader macroeconomic uncertainty, including persistent global trade tensions and evolving geopolitical dynamics, continues to shape investor sentiment. These factors introduce volatility and caution into the currency markets, influencing capital flows and directional bias in EUR/USD. Now finally, we can build some real great trading plans for the euro. USD for the week ahead. With all the information we gathered, let's do some short and medium-term trading plans for you. Remember that both short-term and medium-term trading plans are being built with information from our technical analysis. Let's now discuss both the short and medium-term trading plans individually. As we go through both trading plans, I encourage you to mark these key levels on your own charts and use them for reference throughout the trading week ahead. Let's start off with the short-term trades. Usually 1 to 3 days. Sell the EUR/USD on price's failure to break above the 1.1360 level. Place your stop loss at the 1.1385 level and your target level at the 1.1250. Let's now get to the medium-term trades, usually 3 to 5 days, by the EUR/USD on a confirmed bounce from 1.1250 level. Your target must be at a level of between 1.1380 and 1.1400. With your stop loss placed at the 1.1200 level for exit. While this video focuses on a weekly time frame analysis and forecast, it's important to note that here at X&Y Trading, we apply the same level of in-depth analysis and forecasting every day to the same currency pair, and we send that to analysis and forecasting straight to you as viewer at absolutely no charge at all daily. Yes, only to our precious viewers and subscribers. I think you may agree with me that this opportunity may sound too good to be true. But why not just check this out for yourself? And maybe, just maybe, you may be surprised by what you find. Stick to us, and we will make you rich. You must just make yourself famous, that we cannot do. These daily updates are published on our YouTube channel, completely free of any charge to our viewers and subscribers on the X&Y Trading YouTube channel. You can join our WhatsApp group by clicking the link on the screen or in the video description. You'll never miss out on key updates or daily forecasts we send out. Let's now turn our attention to one of the most fundamental principles in successful trading: risk management. Let's start with the basics. No matter how perfect your setup looks, without a solid risk management plan, you're gambling, not trading. Here's how we break it down at X&Y Trading. 1. Do stop-loss placements on your trades. A stop-loss isn't just a safety net. It's your first line of defense. Always place your stop just below or above a recent swing high or swing low. You can either place the stop loss at a well-defined structure level. Avoid placing stops randomly based on fixed pips. Rather, let structure and price action guide you. Number 2. Position sizing is vital to your success as a trader. Now that your stop is placed correctly, your next step is position sizing, the part most traders overlook. It is important to use a fixed percentage of your account capital per trade. This is typically between 1% and 2% of your capital. This method ensures that no single trade can damage your equity, even when the setup fails, which it eventually will. Remember, your job as a trader is not to win every time. It's to stay in the game long enough to let your edge play out. Number 3 is to place take-profit targets on every trade you enter. Profit targets should be realistic and based on actual market structure, not wishful thinking. Set your take profit at the next key support or resistance level, or better yet, use a dynamic tool like the ATR, or average true range, to measure realistic price movement and volatility-based exits. This method adapts your target or profit levels to market conditions. Profit targets must be tight during low volatility and wide when the markets expand again. Risk management is not optional. It certainly is the foundation of everything we do. Without risk management, no strategy, no indicator, and no signal will save your account. So next time you enter a trade, remember, placing a stop loss protects you. Position size controls your exposure against unfavorable market elements. To place a take profit level ensures consistent reward, and without reward, trading is useless. Think about the following. What is your weekly risk cap? We suggest you stick to a maximum of 3 trades, 3% of your equity, and use structure-based stops rather than fixed pip stops. You are welcome to make use of the following as an example trading plan. You can use it like Lest Control. Number 1. Identify trend direction. Do this by using price structure and moving averages, or alternatively, you can just follow our channel and get the trend or direction from there. Number 2. Check volume. Confirm the breakout or breakdown with increased volume. You can use the volume candles for this. Be cautious of false breakouts, also called fakeouts, or false breakdowns, also called fake downs. These two deceptive moves do often trap traders and can significantly undermine profitability. Staying alert to volume discrepancies can help you avoid these costly traps. Number 3. Confirm your trade with the CMF indicator. This indicator must support the direction of your planned trade. Number 4. Check the RSI indicator. Avoid overbought or oversold territory. To make an entry and look for confirmation from other indicators. Number 5. Wait for an entry signal to open a new trade. Wait for a valid candlestick pattern or structure break to form before you enter a new trade. Number 6. Set a stop loss for your trade. Place a stop loss just outside the invalidation point of your trading plan. Number 7. Set take profit for your trade. Place the take profit at the next major level or based on risk to reward level as decided in your trading plan. Number 8. Monitor your position. Watch for a divergence or reversal signals to adjust or exit the trade. Let us pause here for now. No need to give away the entire playbook in just 1 week. Let's finish off this video now with a look at the market summary. First, the current directional bias is neutral with a slight bearish inclination. Secondly, look at the current key price levels. Closely monitor the support level at 1.1250 and the resistance level near 1.1360. As these two important zones are likely to attract significant market activity soon. Next, look at the technical indicators. Continue tracking the CMF indicator and the RSI indicator for any meaningful shifts in market momentum or sentiment. Finally, the fundamental drivers remain alert to any developments from the European Central Bank and upcoming U.S. economic data, both of which have the potential to trigger volatility in EURUSD. Thank you for watching this week's trading forecast. Remember to like this video, subscribe to the channel, and click the bell so you never miss another setup. And don't forget, join our WhatsApp group for up-to-date trade alerts and deeper insights. The link is right there in the description. And one last reminder, trading carries risk. Read the disclaimer. Don't trade with money you can't afford to lose. From all of us at X&Y Trading, we wish you a successful and profitable trading week ahead. Because remember, sometimes you win, and sometimes you learn.